Welcome back to The Explainer. I am absolutely thrilled to have you here today because, well, we are going to unpack a pretty massive financial mystery. We're looking at a company that is practically woven into the fabric of the global economy, automatic data processing, or as most of us know it, ADP. But right now, there is a huge, glaring disconnect happening. On one side, you have the market price, which has been taking an absolute beating lately. But on the other side, you've got the raw, underlying data metrics of the business itself, and those are telling a completely different story. So today, we're going to let the data do the talking. We're stripping away the market noise, looking exclusively at ADP's financial reality, and seeing if we can solve this puzzle together.
Okay, let's dive into this. 49. Now what does this actually mean? It's not just a random figure. This represents ADP's streak of consecutive yearly dividend increases. For 49 straight years, think about that. Through economic booms, devastating recessions, tech bubbles, global crises, ADP has consistently handed more cash back to its shareholders every single year. That instantly establishes them not just as a successful business, but as an absolute titan of reliability. You don't accidentally raise your payout for half a century, right? You do it because your underlying business model is an unstoppable cash-generating machine with a wildly durable competitive advantage.
So here is our roadmap for today. 1. A history of massive returns. 2. Looking under the hood at profitability. 3. Analyzing the growth engine. 4. The recent price dip. And 5. Valuation. And checking to see whether we've actually found a hidden bargain here.
All right, Section 1, a history of massive returns.
We really need to frame the current situation against the company's long-term pedigree to understand the contrast we're dealing with. It's literally visual whiplash when you look at the short-term versus the long-term performance. Year to date, the stock is down almost 16%. And if we zoom out to the trailing 12 months, it's even worse, a really painful 30.39% drop. That is a lot of short-term bleeding. Honestly, it's enough to scare away most casual observers. But then you look at the long-term compounding. The 10-year return is a staggering positive 207%, and the 20-year return, an incredible 942%. What this tells us is that we're looking at an elite long-term compounder going through a severe short-term crisis of confidence.
Moving on to Section 2, under the hood, profitability.
The natural next step here is to completely ignore the stock ticker for a second and look at the actual business. Is the business fundamentally broken, or is the market just overreacting? Well, look at these margins. They are nothing short of spectacular. We have a return on equity of over 68%. That means for every dollar of equity, ADP is generating an astonishing amount of profit. They boast a gross profit margin of over 46%, which shows immense pricing power. And their net profit margin is a very healthy 19.9%, meaning basically 20 cents of every single dollar they bring in drops straight into their pocket. These are not the metrics of a dying business, guys. These are the metrics of a wildly profitable, highly efficient core economic engine.
And you know what's crazy? They aren't achieving these massive returns by loading up on reckless debt either. ADP operates with a very conservatively financed balance sheet. The debt-to-equity ratio sits at just 0.63, meaning they rely far more on their own equity than on borrowed money. Plus, the current ratio is 1.04, which tells us they have more than enough liquid assets to cover their short-term liabilities. So we've got a highly profitable business resting on a rock-solid foundation of financial stability.
Okay, Section 3, analyzing the growth engine.
We know they're profitable today, and we know they're financially secure. But is ADP just resting on its laurels, or are they actually still growing? Well, looking at the 5-year compound annual growth rates, revenue is growing steadily at about 8%. But notice what happens as we move down the income statement. Net income is growing even faster at nearly 12%. And absolutely crucially, free cash flow, the actual hard cash the business can use to reward shareholders, is compounding at over 13% a year. That shows amazing operational leverage. The underlying business is scaling beautifully. Despite the market knocking 30% off the stock price in the last year, the actual cash generation of the business is growing by double digits.
And all that growing free cash flow, it directly feeds the dividend timeline. The current yield is sitting at an incredibly attractive 3.17%, which is noticeably higher than its historical averages. Why? Because as the stock price drops, the yield goes up. But the dividend itself isn't static. It has a 5-year compounding growth rate of 12.8%. If that trend holds up, look at the projection, a 10-year forward yield on cost of 8.22%. This essentially means investors buying today are being paid incredibly handsomely just to wait for the market to realize the business's true value.
Which brings us to Section 4, the recent price dip.
Now we have to address the elephant in the room. What did that 30% trailing 12-month drop actually do to the stock's valuation multiples? Here, we're looking at the classic price-to-earnings, or PE ratio.
Right now, it sits at 20.01. For a company of ADP's quality, with 68% return on equity and double-digit growth, a 20 PE is generally considered a total steal. But check out the comparison. That current multiple is almost 29% below its own 5-year average. The market has violently compressed the premium it's willing to pay for ADP's earnings, essentially putting the stock on a massive discount rack compared to its usual historical norm. And it gets even more fascinating when we look at cash, because, earnings are an accounting metric, but cash is reality. The current price-to-free cash flow ratio is 17.83. This translates to a free cash flow yield of over 5.6%, which is fantastic. But again, look at the comparison. This cash flow multiple is a staggering 31.59% lower than its 5-year average. Think about that. The core business is pumping out 13% more cash every year, yet the market is charging nearly 32% less for each dollar of that cash than it usually does. Literally, the very definition of a fundamental disconnect.
All right, our final section, Section 5, Valuation. Is this a hidden bargain?
We've seen the profitability, we've seen the growth, and we've seen the multiple compression. Now, it's time to put it all together and calculate the absolute intrinsic value of this business. The source data relies on a discounted cash flow, or DCF, model. Just as a quick refresher for everyone, DCF is an absolute valuation method used to estimate a stock's true intrinsic fair value based entirely on projecting its future free cash flows and discounting them back to today's dollars. It absolutely doesn't care about market sentiment. It only cares about the mathematical reality of the cash the business is going to produce.
And so, here is the big reveal. The last closing price of ADP stock was around $214. That is what the panicked, sentiment-driven market is currently charging you to buy a share. But when you run the actual numbers, the 13% cash flow growth, the robust margins, the DCF fair value price comes out to roughly $508. Let that sink in for a second. The mathematical model suggests the company's future cash streams are worth more than double what the market is currently pricing them at today.
That massive gap, it translates to a quantitative margin of safety of almost 58%. In the world of investing, finding a high-quality, wide-moat, dividend-growing titan with a nearly 58% margin of safety is practically like finding a unicorn. It means that even if the DCF projections are overly optimistic, even if ADP's growth slows down a bit, there is such a massive cushion built into the current stock price that the downside risk is mathematically incredibly minimized compared to the upside potential.
And that leaves us with this final, very provocative question. We've got a company boasting a 58% margin of safety. It operates with an elite 68% return on equity, it has raised its dividend for 49 consecutive years without fail, and its free cash flow is growing by double digits. Yet, the stock is down 30% in the last year. So I ask you, is the market entirely wrong about ADP? Has short-term panic created a generational entry point for focused learners willing to just trust the data? I highly encourage you to review these numbers, do your own further research, and answer that question for yourself. Thanks for joining me on this explainer. I always love unpacking this data with you. Until next time, stay curious and keep learning.